Hello, I'm Julie Price, and welcome to Juniper's fourth quarter 2021 economic review. I'm so glad you tuned in. Thank you very much. As we enter the fall of 2021, the U.S. economy is continuing to rebound from the pandemic recession. However, the road to recovery has been bumpier than expected in two ways. One, with the Delta variant hurting the travel and entertainment industries, and two, continued supply chain constraints, which has contributed to increased inflation and has impeded production. Thankfully, there are now signs that the latest wave of the pandemic is beginning to ebb. If this continues, then the economy should reaccelerate, helped by strong gains in equity markets and home prices, pent-up consumer demand, and the continued impact of fiscal stimulus. The months ahead will still see economic challenges as strained supply chains, rising inflation, and labor market distortions remain headwinds for the U.S. recovery. In addition, policy is set to become slightly less accommodative from both the Federal Reserve and federal government. Looking forward to 2022 and beyond, the global economy should hopefully see a synchronized boom as the pandemic retreats. To help us out, we turn to JP Morgan's Guide to the Markets. In particular, we start with an update on the progress of combating the pandemic. We then look at the pace of recovery, considering trends in economic growth, jobs, profits, and inflation. This is followed by comments on fiscal and monetary policy. Finally, we consider the implications of all this for those investing in U.S. fixed income and equities, as well as international equities, and highlight the importance of investing in a diversified way in this still rapidly changing environment. Join me while I discuss these topics and more using the analyses from the experts at JP Morgan. After substantial progress in reducing cases and fatalities in the spring, the pace of vaccinations has slowed, and the much more contagious Delta variant has caused a resurgence of the pandemic. That being said, JP Morgan now estimates that between infection and vaccination, roughly 85% of the American people now have some immunity to COVID-19. This should allow cases and fatalities to fall in the months ahead. Further, while the pandemic isn't over yet, many parts of the economy have adapted to operate in a pandemic environment. We hope that this pandemic will fade as we move into 2022, but whether it does or not, it should have much less of an impact in slowing the economy than it has over the last year and a half. People have become accustomed to dealing with a pandemic and are finding ways to buy goods and services within their comfort zone. The federal government has hit a new record high debt to GDP ratio, levels we have not seen since World War II. The $1.9 trillion American Rescue Plan is still working itself through the system and will continue to support the economy through the end of the year and into 2022. Further, negotiations continue in Washington on additional spending aimed at infrastructure, childcare, and education, among other initiatives. However, a new stimulus would be stretched out over a decade and at least partially financed by tax increases, providing much less stimulus to the economy than we have seen over the last 2 years. In 2022, the economy should be much healthier than over the last 2 years, but it will also receive much less government support. Consumer balance sheets held up remarkably during the pandemic, thanks to the massive fiscal support that was geared toward the lower end of the income spectrum. On the top right, we see the household service debt ratio, which is the percent of after-tax income used to make payments on mortgages and other consumer debt. At about 8%, it now sits at a 40-year low. On the bottom right, we see household net worth, which only modestly retreated during the pandemic and has since seen significant growth with large stock market gains. The road to pandemic recovery has been bumpier than expected, with the Delta variant and severe supply shortages cutting into consumer and business spending. However, we expect growth to reaccelerate late this year as reopening resumes and companies try to rebuild inventories. As we move into 2022, the economy should have fully recovered from the pandemic. Then, looking forward, a shortage of workers and much less fiscal and monetary stimulus should slow economic growth to its long-term trend of roughly 2% by the end of next year. This page aims to address the income inequality issue in the U.S. On the bottom left-hand side, we show that the percentage of overall income received by the top 10% of Americans has been rising and recently eclipsed 50%. The chart on the left compares spending as a share of income for the top 10% and bottom 90% of Americans. While the top 10% has been receiving more income as a share of overall income, they tend to spend less than the bottom 90%. While this puts downward pressure on traditional inflation and economic growth, it instead fuels financial asset appreciation, which we show on the right. With surging labor demand and a higher cost of low-wage labor due to enhanced unemployment benefits, employers have had to raise wages to attract workers. This slide shows that as unemployment has fallen, wage growth has been rising and is above historical trends. While recent employment reports have disappointed expectations, rising wages and indicators of robust labor demand suggest slower job gains are primarily an issue of labor supply. This should keep wages elevated as the recovery continues and is critically important for the Federal Reserve, as higher wages should feed through to higher inflation, implying that the economy could reach maximum employment sooner than past cycles. Inflation signals have heated up significantly as the surge in consumer spending continues to collide with supply shortages across major sectors of the economy. Some drivers of much higher inflation are beginning to abate, and JP Morgan expects inflation to moderate in 2022 as supply chain disruptions are ironed out and demand growth cools. However, strong wage growth, higher inflation expectations, a falling dollar, and the lagged effect of higher home prices on rents should keep inflation more elevated than at the end of the last expansion. While Delta poses a risk, the economic recovery has been robust and the Fed is intent to keep it on track. At its September meeting, the Federal Reserve gave markets an update on how it expects the broader economy to perform over the next few years. In general, the committee appears cautiously optimistic and still expects growth and inflation to run above historical trends, but cool down as we move into next year. Also, with companies paying more to attract workers, job growth should remain solid. While this is mostly good news, the Fed still wants to keep interest rates low for as long as possible and may not begin raising rates until late 2022 or 2023. However, JP Morgan continues to expect that they will begin to reduce bond purchases by year-end. The combination of very easy monetary policy and a recession has left the 10-year Treasury yields at very low levels. Interest rates will likely move higher into 2022 against the backdrop of rising inflation, faster growth, and a less accommodative Fed as they begin tapering. There continues to be a place in portfolios for fixed income to provide diversification and some potential protection in the case of an equity market or economic relapse. But we may want to focus on shorter duration bonds to be well positioned if long-term rates resume their ascent. This slide shows S&P valuation dispersion over the last 25 years, illustrating the recent widening valuation gap between the most and least favored stocks in the S&P 500. The current valuation spread is markedly higher than the 25-year average. This wide dispersion in valuations points to an opportunity for adding some active management. The U.S. economy has had a bumpier recovery than expected, but is still on strong footing as we enter the fourth quarter, and further progress on the pandemic at home and abroad should continue to be a tailwind for the global economic recovery. Given the substantial growth markets have had thus far in the economic cycle, we should continue to focus on maintaining a somewhat diversified stance as we move forward to a, hopefully, much better 2022. U.S. equities have trended higher during the course of the year, characterized by range-bound valuations and rising earning expectations. Stock prices based on the current forward PE ratios still look elevated, although they have come down somewhat as earnings have played catch-up. Looking forward to 2022, returns will depend more heavily on profit margins. Rising wages, supply chain disruptions, and higher taxes could all negatively impact profit margins over the next few years. However, while elevated valuations may pose a speed limit for the market, the outlook for returns remains positive amidst strong fundamentals and corporate profitability. The price-earnings ratio is the driver in this chart on the x-axis. As PE increases, the rate of return on the y-axis decreases. The correlation displayed for one-year data shows a very loose correlation. That's why we see an R-squared of only 4%. The dots on the scatter chart are largely random. But when we look at the 5-year data, the dots show a much tighter correlation along the trend line with an R-squared of 41%. So PE does not necessarily have a predictive power in terms of returns over a short time period, but there is a much tighter correlation when using longer periods. Earnings have recovered spectacularly since the big declines in early 2020 and are now expected to hit a new all-time high in 2021. This reflects both stellar profits in sectors like technology and strong profits in healthcare throughout the pandemic, but also a rebound of many of the cyclical sectors that struggled the most last year. However, from 2022 on, slower economic growth, higher wage costs, higher interest rates, and potentially higher corporate tax rates could make further profit gains much more difficult to achieve. After multiple years of strong outperformance of growth stocks, most notably during the pandemic in 2020, value has begun to recover. The left chart shows that even after a good start to 2021, value appears to remain cheap relative to growth compared to long-term averages. Additionally, value generally tends to outperform growth during periods of above-trend economic activity and rising interest rates. However, we would be wise not to abandon growth stocks altogether, as the economy is likely to slow down to a much slower pace of economic growth later in 2022 and into 2023, and growth stocks have traditionally outperformed value stocks in a slow economic growth environment. This chart helps us understand the drivers of oil prices. We see on the left side inventories increased as Russia dumped an enormous glut of oil onto the market as the pandemic hit, resulting in a decrease in active rigs and a drop in oil prices down to $11.57 a barrel. Since then, Russia agreed to reduce its oil production, and airlines and other oil and gas consumers increased consumption as the effects of the pandemic lessened. So as inventories decreased, active rigs increased, leading to an increase in oil prices now at almost $80 a barrel in mid-October. So we will see continued increases in gas at the pump as gas prices lag oil prices by about 3 months. While the expected synchronized global recovery has been delayed, it has not been derailed, and vaccination progress overseas has gained speed, with many countries now outpacing the U.S. despite our strong start. JP Morgan expects the global economy to continue to grow above trend over the course of next year, and for robust earnings growth to be an important catalyst for international markets. Valuations remain attractive, with both emerging market and developed market stocks at some of their cheapest levels relative to the U.S. The current valuation is shown by the blue diamond and the 25-year average in purple. This, along with global post-pandemic economic rebound, lower trade tensions, and the prospect of a lower dollar in the long run, argue for a greater allocation to international equities, with a particular focus on East Asia and Europe. This slide shows that over the past 50 years, there have been different regimes of U.S. versus international outperformance. A regime change is defined when there is sustained outperformance of one region over the other for a cumulative 12-month period. Given cyclical tailwinds for international equities as we emerge from the pandemic, we could be entering a period of international performance ahead. This slide takes a closer look at global supply chains. On the left, we show the Global Suppliers Delivery Times Index, which captures the extent of supply chain delays in the global economy. Manufacturing and construction companies were asked, are your suppliers' delivery times slower, faster, or unchanged from 1 month ago? A level of 50 marks no change, below 50 reports slower delivery times, and above 50 denote faster delivery times. As you're well aware, with the post-COVID-19 rebound, global supply chains have been quite choked. On the right, we see global input and output prices for both the manufacturing and services sectors. Below 50 means falling prices, and above 50 means rising prices. Increased input prices tend to lead to increases in output prices, especially as inflation rises. This page provides a great visual snapshot of global economic activity by looking at various countries' purchasing manager indices in a heat map format. For PMIs, a level of 50 marks the difference between accelerating and decelerating growth. Green indicates that the economic growth is accelerating, and red indicates that economic growth is decelerating. In the last couple months, most countries are green except for emerging markets, Japan, China, and Russia. JP Morgan expects to see more green on this chart by year's end. We'll conclude this quarter's economic review with a look at the matrix as of September 30th. Commodities took the top spot from real estate last quarter with a year-to-date return of 29.1%. After a tough 2020, real estate has had a big comeback this year of 21.6%. U.S. large cap is next at 15.9%. Now, I'd like to point out that it was also strong in 2020 and 2019, which may make it more likely to not see such high growth in the next few years. U.S. small cap equity remained strong after being in the top slot last year, up 12.4%. International developed markets up 8.8%. High yield is the best performing fixed income asset class, up 1.7%. Emerging markets have been struggling, largely due to China, and fixed income is at the bottom, down 1.6%. In review, the U.S. economy is looking in great shape as we enter the fourth quarter, and continued progress on the pandemic at home and abroad will be vital in keeping the pace of global economic recovery. Given the substantial progress markets have made in recovery, we should focus on the fundamentals we've discussed and maintain a diversified stance, taking advantage of more active management as we enter a new era in the post-pandemic world. Thank you very much for making it all the way through this quarter's review. As always, please feel free to reach out to me to review this and more.